For more on what the S&P report means for the market, for investors, and for you, we've assembled a Taking Stock think tank. We have Michael Woolfolk. He is a managing director and senior currency strategist for the Bank of New York Mellon. He pays attention to all those cross rates and economic reports. Also, we have Douglas Holtz-Eakin. He is the president of the American Action Forum. He joins us from Washington, D.C. He's a former director of the Congressional Budget Office and chief economist for the President's Council Economic Advisors. We promise not to hold that against him. And also Joseph Tanious, he's a vice president and market strategist at J.P. Morgan Funds. Gentlemen, great to have you with us. Let me begin, Michael Woolfolk. Let me just understand. Earlier today, before this news headline about Standard & Poor's and the negative watch, stocks outside the United States, they were already falling. People were already selling equities. This just added to that. What do you think it really means? Were people just looking for an excuse to take some profits? Because stocks have been up.
Well, you're hitting the nail on the head, Pimm. This was not, surprisingly enough, the event of the day. The event of the day actually happened in European trading, where increased concern about debt default by Greece began to spread. We saw bonds.
20%, right? Can we use that as a number? 20% is the interest rate for two-year Greek government debt.
Well, certainly what I saw was between 17 and 19%. It may have got as high as 20%.
Okay, maybe I think there was a story that there was a print of 20% in London. But, Art, even 17%.
Yeah.
Is that considered high?
Well, 20% on the nominal, maybe 17% on the spread. Okay. Remarkably high. Okay. To the point where Greece is going to have a very difficult time rolling over debt in the near term at those rates. So instead of something happening in the next few months, something has to happen really in the next few weeks or even days. This is a very serious situation. It also has an impact on the peripherals. So that was something that the market was reacting to. The market sentiment shifted from being pro-risk to being negative on risk, and consequently, equities sold off. Now, on the back of that this morning, you had this decision by S&P, which only added fuel to the fire. This is certainly something that you would think would be fundamentally negative for the U.S., to the economic outlook and investment picture, but the U.S. dollar rallied. The U.S. dollar rallied because, of course, the dollar is a safe haven, and the market was overly short U.S. dollars just now.
Douglas Holtz-Eakin, come in on this topic. I mean, you're in Washington right now. I would imagine most people in Washington don't spend a lot of time using the words Standard & Poor's in the same sentence. Is this going to be the topic when people break for dinner today?
Certainly, this has gotten everyone's attention. Standard & Poor's was looking at the U.S. outlook as far back as 2003 when I began at the Congressional Budget Office. But this is the first time it has come public with a negative watch. It's not really surprising that at some point this was going to happen. Analysts and financial market participants have been looking at the federal budget for years. It's a picture that hasn't changed much over time. We see the revenue and spending lines diverging as far as the eye can see. And implicitly, you have to assume that market participants and analysts were assuming some sort of budgetary fix in the future. What Standard & Poor's said today is, you know, it might not happen. And certainly if it doesn't happen, we have a financial disaster for the government and an economic disaster for the U.S.
Joe, let me come to you and propose that most investors who have been reading anything or listening to any business news, they already know that the government's in financial trouble, right? $14.2 trillion of debt. We've got a budget deficit. We just went through a stopgap spending measure to get us through the next 6 months of the fiscal year. This is not brand new.
You're absolutely right.
Is this really just news for the congressional leaders and the politicians?
I think it might be. I mean, you kind of go back to Friday and you go to today and you ask yourself, what's changed between, the weekend? And the answer is nothing really. You've had a change in opinion from one rating agency, and that opinion reflects the possibility, or I guess that the likelihood of Washington reaching an agreement on this deficit issue becomes, or I guess it's become less likely. But what investors need to realize is that the fundamental drivers behind the equity markets, as we talk about the health of corporate balance sheets, as we talk about profits, as we talk about margins and valuations, all of those underlying drivers remain intact. And from our standpoint, we see the sell-off today really as a buying opportunity for long-term investors.
All right, so a buying opportunity. Let me bring in Douglas on this because, Douglas, I'm curious, is fear a big motivator in Washington, D.C.? We know that fear sells, particularly when you're on the campaign trail. But is fear a big enough motivator to get the politicians to come up with some kind of reasonable compromise?
Much easier than reaching across the aisle and making friends is fear of a common enemy. And if the enemy is financial markets, it will drive the political process. You have to understand that what ultimately went on today is that there was a political judgment drawn by S&P that they wouldn't get a deal. And they have to make some sort of political forecast because our system doesn't automatically produce a budget or a fiscal policy. Instead, we have warring parties within and across the branches of government. I think this is an unambiguously bad thing taken at face value. Market participants are getting edgy about the possibility of a deal. It'll only turn out to be a good thing if it forces faster action on real changes in the federal outlook.
Michael, this idea of market participants, where else are they going to put their money? Overseas?
Well, exactly. I mean, one of the things that has been happening since the Lehman crisis has been that the emerging markets have performed better than the G7, than the developed markets. Once risk appetite returns, that money, again, goes back into the riskier plays, such as overseas, less so in the U.S. Right now, the trend is to square up your short dollar and short yen positions in the marketplace. But overseas assets have done remarkably well, and certainly commodities, equities, emerging markets are part of that.
So do you think that that's going to continue and that what happened today is just going to give further impetus to that? Because certainly anybody making a sales call, talking to their clients, are going to be able to wave the headline, at least in tomorrow's newspaper, and say, look at this.
I think ultimately, at the end of the day, what you've seen happen today is the result of fear. Right, there's a lot of fear in the market. There's a lot of uncertainty around how Congress is going to come together and compromise between the Ryan plan and the Obama plan. And while there are certainly substantial differences between the two plans, the underlying objective in what they try to reach and what they're aiming to reach is the same. I think ultimately, at the end of the day, you have to have both the right and the left side of the aisle come together and form some compromise. And if you believe that, in fact, is going to happen, what you've seen today in terms of the equity market selling off and CDS spreads spiking and rising, I do think all those things will unwind themselves.
Douglas, one of the other things that Standard & Poor's came out today and said is that while they were putting the United States AAA credit rating on negative watch, they weren't doing anything to the municipal bond market. What do you make of that?
Well, I think there are two lessons out of this. And the first is that the market participants are forced to evaluate political judgments because it threatens the economic fundamentals. They should be in a position where they're just looking at balance sheets and cash flows and making informed judgments about that. We now have the federal government threatening the economy with a debt crisis that becomes a big part of their valuations. If you look at the state and local level, we see more capacity for leadership. We see greater ability of governors and mayors to take on these problems, ranging from an Andrew Cuomo in New York, a Democrat, to Chris Christie, Republican, Mitch Daniels out in Indiana. So there's a lesson there that perhaps the other levels of government are more nimble and more capable of dealing with these problems and getting out of the way of the private sector.
Michael Woolfolk, what lesson can we take away from today's move by Standard & Poor's in the oil markets, commodities? Because oil sold off. If indeed we have a debt crisis in the United States, what's that going to do to economic growth and demand for things like oil?
Well, a couple points there, Pimm. Certainly, oil sold off, but gold did not.
Right.
Okay? There's concern, so some fear out there, and gold seems to do well when people are peddling fear. What's going to happen in terms of the next, let's say, 6 to 12 months if things continue to escalate? Certainly a drawback in, or let's say a scoring up of positions in long commodities is going to be a continued negative. It's going to undermine commodities. If the dollar continues to strengthen, these commodities are primarily denominated in dollars. Dollar strength is going to erode the value of those commodities in dollar terms. So
that's going to make it so difficult for you, Joe, because now, it used to be almost like a one-way trade, and now you're thinking, all right, so if we have a debt crisis in the United States, if people flee to the U.S. dollar, commodity prices are going to go down. How bizarre.
Yeah, well, I think as we talk about commodity prices, I mean, you're looking at really a secular trend. There's a secular growth story in the emerging markets, which really helps make the case for commodity investing overall. I think what investors need to do is just take a step back. We always talk so much about where should you be positioned from a tactical standpoint, and really investors need to think about where are they relative to their strategic allocation.
Because I want to ask Douglas about whether solving the government's budget problem on the spending side or the revenue side, does it make sense which side of the equation we deal with first?
Well, it certainly matters for investors. It matters for the economy. If you're a bond holder, you don't care which side they solve it on. You just want to get your money and take the debt crisis off the table. But if we solve it on the tax side, that's going to be bad for growth. It's going to be bad for economic fundamentals, and it's going to be bad for those who put a weight on U.S. equities. They want to be outside the U.S. If you solve it on the spending side, that's going to be a very pro-growth policy. It's going to be good for economic fundamentals in the U.S., be good for those who have a heavily weighted U.S. equities. It's also going to be better for the dollar because of the pro-growth incentives. So I think what you're seeing out of the market today is the yields rally on the notion that we're going to see this thing fixed, and the dollar stronger on the grounds that it's going to be on the spending side.
Well, Joe, that really speaks to what you were describing earlier, right? I mean, in terms of, okay, now that everybody's got the message that this is really serious stuff, what are they going to do, and how is it going to affect asset allocations? What are you seeing? Strategic asset allocation? What is it, and why does it matter?
I think so. I think so many investors are concerned, and they get bogged down in the day-to-day, news that came out from Portugal, or what's going on in Greece today, or sort of this news from S&P.
And yet they will never trade Portuguese or Greek
right.
debt. That's also important.
But as soon as those headlines come out, it rattles the market.
That's
investors get nervous, and they begin to think about how should I make a tactical play here, either going overweight or underweight in this particular category, this asset class. What investors need to do is take a step back and think about how are they invested relative to their strategic allocation. Right, you have to develop some strategic allocation relative to your long-term risks and goals and objectives.
And they can be very individual if
Absolutely.
It's an individual investor, or it can be a specific mandate for a pension fund or an insurance company.
Absolutely, and then rebalance, as needed, and that's something you obviously discuss with your advisor. Again, ultimately, I think what we've seen today in terms of the equity market selling off is a bit of an overreaction. We think that the underlying drivers behind the equity markets remain intact, and what you've seen will probably unwind itself over the next few days.
Michael Woolfolk, coming on this topic of keeping the market honest, because it has been a one-way trade to sell the U.S. dollar. Yes. Right? I mean, you would make money if you had taken that bet for the last 3 to 5 months.
Oh, certainly.
Now you're saying, beware, it's not a one-way street. What do you mean?
That's right. Over the last several months, you've been short U.S. dollars, you've been short yen, certainly since the intervention that we saw several months ago. And I think the reason is clear. You want to borrow in zero interest rate U.S. dollars or yen, take that money out of the country and invest that in 6-7% bonds elsewhere.
Could be a place like Australia, for example, which is dealing with inflation.
Could be Brazil, which is fighting currency strength.
Exactly.
Which is imposing capital controls, which has many frustrated, including the IMF. I think that the reason why you had this sudden reaction today is it is a reflection of just how oversold the U.S. dollar and the yen had become. And so we need these episodes of market risk, angst, if you will, to keep investors honest. I mean, if you don't feel comfortable with a risky position, you shouldn't be there. And I think that was what got us into trouble leading up to the Lehman crisis. So,
do you feel the same way about gold? Because, I mean, you started this by talking about the divergence between the price of gold and then the value of a barrel of oil.
Yes.
Obviously, gold, a different store of value. You can have a lot of conversations about that with investors. But do you think that's also possible with gold at almost $1,500 an ounce?
It seems that that's probably, there's a fear factor there and some speculation built into that price. However, it's a very unique commodity. and it's a store of value unto itself, I think I'd put that aside. I think that there's upside potential to gold. I'd be a little bit more concerned with some of these other precious metals and perhaps the non-precious metals and some of the other commodities in the agricultural space, which seem a bit rich right now. But nonetheless, I think the longer-term trend is that with strong growth coming out of China, India, and the Asian region, it will provide further upside potential for commodities.
Douglas Holtz-Eakin, coming on the topic of Washington, you're an expert as to what gets talked about. How long is this going to grab the attention of lawmakers, or is it going to be supplanted by local concerns? Congress is in recess. They got to be at least hearing this and reading about it. Is it going to grab their attention for long enough to get some kind of decision?
It's going to grab their attention while they're on recess. The second topic on recess will be the price of gasoline. But when they come back, they're facing budget negotiations. They're facing a debt limit increase. And this topic will not go away between now and 2012. It is a central feature of the political debate.
I want to thank you, gentlemen, very much.